Let's talk about your view on whether the economy is going to slow markedly this year in the United States and maybe even lapse into a recession. Everybody sort of seemed to be predicting it for 2023. It didn't happen. Relatively fewer people are predicting it for 2024. That may mean it will happen. What do you think?
Yeah, I think the odds for a technical recession are probably a toss-up. And that sounds a bit of a cop-out, but the simple reality is you are going to see slowing growth. And that's not necessarily a bad thing from a market perspective, because as we know, there's a lot of debate going on around what central bank policy will do as we see slowing growth, on top of the fact that inflation continues to be disinflationary. And so generally speaking, we think there's a decent odd we'll see a technical recession, but at minimum, we are in an environment that's slowing growth. But the growth that's slowing in the U.S. is still reasonably better than what we're seeing in the rest of the world. So the dynamics are still in favor of the United States when it comes to global growth being in favor of the U.S. relative to many other areas of the world.
Stock markets aren't really foreshadowing a recession of any sort, technical or otherwise. Right now, the Dow is up 303. The S&P 500, as we've been pointing out, at a record high. Even if the economy slows, and whether or not it goes into a, quote, technical recession or not, can this be a good year for equities? Do you expect it will be, even if you don't expect it to be as good a year as 2023 was?
I do believe it can be a respectable year for equities. I think we'll have an air pocket at some point in time during the year. But even if we go into a shallow or slower growth environment, I think it's a fairly narrow window of maybe at most a quarter or two. So you may get a couple air pockets where, the S&P and U.S. equities have a 5 or 10% correction, but the tail end of that will also be beneficial as we start to move on to the next upcycle, both in the U.S. but also globally. So this year we do expect positive returns for the U.S. S&P as well as many global equities around the globe.
Let's talk about the kinds of stock sectors that you think look attractive given their current valuations, maybe given the fact that they weren't major participants in last year's run-up. Where would you be looking to put fresh money today in equities?
I think there's a couple areas. One, last year was a big disappointment for certain types of equities, particularly those that were higher dividend, higher quality, more cash flow-oriented type of companies. I think with some of the uncertainty around growth this year in the U.S. as well as across the globe, those types of factors and those types of stocks that qualify as bigger dividend producers, more consistent earnings profiles, companies that tend to hold up better when you have a slowing growth environment, should do a lot better than they did last year. And an example of that would be the healthcare space. Healthcare was one of the worst performing sectors last year, but is expected to have among the highest growth from an earnings perspective this year, likely north of 15% growth, on top of the fact they're trading at multiples that are lower than the broader equity markets and relative to history are pretty attractive to their own relative valuation. So healthcare and more dividend-oriented stocks are two ideas that we're focused on for 2024.
And internationally, I see you are favoring an overweight in Japanese equities.
We have been on board with the Japanese equity trade for a while. We continue to like it. Japan equities do trade at a discount relative to many other areas of the world. But we're also seeing a central bank that has a lot of accommodation there. Yes, there's some debate on whether we'll try to normalize it, but relatively speaking, it's still going to be a central bank that's generally accommodative. On top of the fact you have some structural dynamics going on in Japan, particularly as it pertains to more shareholder friendliness and passing along higher earnings growth potential, as well as pushing dividends out to shareholders.